Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at AST Space Mobile.
If you find our talks useful, please consider subscribe, like, and comment underneath because today we are looking at a story that is just absolutely dominating market conversations right now.
Oh, everywhere. It's all anyone is talking about.
Right. And, the stakes really could not be higher here. I want you to imagine trying to build this global cell tower network, but every single tower costs tens of millions of dollars.
Yeah, massive capital.
Right, and it has to be blasted into the actual vacuum of space on a rocket. And the kicker is, you aren't even allowed to charge a single customer for the service for another 3 years.
That is exactly the situation.
So that is the $26.6 billion gamble that we're unpacking today with AST Space Mobile. I mean, you have these successful space launches, these massive European telecom partnerships, and they're just colliding head-on with this brutal cash burn.
Yeah.
And, of course, the looming shadow of Elon Musk's Starlink.
Yeah, it really is just the ultimate high-wire act of corporate finance and, well, technological ambition, wrapped into one.
Completely.
But before we start untangling this incredibly complex pre-revenue space narrative, I do want to point out a really useful resource for long-term investors who are looking at these kinds of highly speculative plays. You can actually explore StockOracle through the special 14-day trial link below in the description.
Oh, yeah, definitely check that out.
Right, because StockOracle, it's an AI-aided stock research platform for long-term investors. And it brings together company fundamentals, the OracleIQ stock appraisal, OracleValue intrinsic value estimates, AI moat analysis, and your watch lists and portfolio tools just all into one place.
Which is super helpful when you're dealing with all this data.
Exactly. But we do have to mention, keep in mind this is a research platform.
Yeah.
It is strictly not financial advice. It's not a recommendation to buy or sell, a trading signal service, or real-time market data. The AI analysis and valuation estimates, well, they can be incomplete or wrong, and the data may be delayed.
Right, so you always have to verify important facts yourself.
Always. Make your own decisions. And just so everyone knows, this is an affiliate link, so the channel may earn a commission if you use it at absolutely no extra cost to you.
Awesome. All right, let's move into the wealth building context here.
Let's do it.
Because before we get totally swept up in the romance of rockets and low Earth orbit, which is easy to do, we really need to establish exactly where a company like this fits into an actual portfolio.
Yeah, the grounded reality of it.
Right. I mean, if you're a listener trying to build long-term wealth, how on earth should you be viewing a $26 billion space company that basically has zero commercial revenue yet?
Well, you have to view it strictly through the lens of highly speculative growth. That's just what this is. This is fundamentally a high beta play. Like right now, the stock has a beta of 2.81.
Okay, wait, let's translate that for a second for everyone.
Oh, yeah.
A beta of 1 means the stock moves, basically in lockstep with the broader market, right?
Exactly. Beta of 1 is the market baseline.
Okay, so at 2.81, what does that actually look like on, say, a random Tuesday morning when the opening bell rings?
It means hyper-amplified volatility. Mechanically, if the broader market, like the S&P 500, moves up 1%, this stock is statistically modeled to jump nearly 3%.
Wow, okay.
But, that works in reverse, too, and that's what catches people out. If macroeconomic fears cause the broader market to just pull back slightly, this stock could experience a really violent double-digit sell-off.
Oh, brutal.
Yeah, it's incredibly sensitive to the overall risk appetite on Wall Street. So this is absolutely not for your defensive, income-generating sleeve of your portfolio. The entire long-term wealth thesis rests on one monumental technological shift, which is direct-to-device, or D2D, satellite connectivity.
Okay, I actually want to pause on that specifically, because this is where the physics of it all kind of just melt my brain a little bit.
It's wild technology, yeah.
Because direct-to-device means a standard, unmodified smartphone, like the one sitting in your pocket right now, connecting directly to a satellite hundreds of miles up in space.
Right.
How is that physically possible? I mean, a smartphone antenna is designed to whisper to a cell tower that's maybe 2 or 3 miles down the highway. How does that weak little signal reach all the way to low Earth orbit?
That is exactly the multi-billion-dollar engineering question right there. And it's why AST SpaceMobile's approach is just so fascinating, because you're absolutely right. Your phone's antenna is weak. It just can't shout loud enough to reach space.
Right, not even close.
So AST isn't trying to change the phone at all. Instead, they're basically building massive ears in space.
Okay, massive ears.
Yeah, so they're Bluebird satellites. They unfold in orbit to become these gigantic phased array antennas. I mean, we are talking about structures the size of a tennis court just floating out in space.
Oh, wow, a tennis court. So it's essentially a giant orbital microphone designed to pick up the absolute faintest possible signal from the ground.
Precisely, yeah.
Yeah.
They're aiming to become the invisible, space-based infrastructure for the exact phone you already own, just eliminating dead zones entirely.
That's incredible.
If they can establish a competitive moat, it's going to be built entirely on the back of this massive orbital hardware and their partnerships with terrestrial telecom companies.
Right, but building massive tennis court-sized satellites and putting them on literal rockets isn't exactly a side hustle you bootstrap out of your garage. You know,
Definitely not.
the upfront capital required here has to be absolutely staggering. It really feels like you're funding the construction of a multi-billion-dollar toll bridge, but you're having to build it in the middle of space.
That's a great analogy.
Right. You're pouring all this raw material, this labor, and massive amounts of capital into the project, and you have to do all of it before a single car is allowed to drive across and actually pay a toll.
That gives us the bigger picture perfectly. Now, let's look at the fundamentals. Because if we pull up the balance sheet, you see the brutal financial reality of building that space bridge you just mentioned.
I bet it's ugly.
It is. When I say this is a pre-revenue company, I mean the revenues are just completely negligible right now. I mean, you might see a headline out there screaming that their trailing 12-month revenue grew by 1,732%.
Wait, 1,700%.
Yeah.
That sounds like you found the next Amazon. But what is the actual dollar amount behind that massive percentage?
That's the catch. It's growth from a near zero base.
Ah, gotcha.
So it's statistically irrelevant to their actual survival right now. The reality is that meaningful, recurring commercial revenue is not expected to even begin until their service officially launches, which is targeted for fiscal year 2027.
Okay, so a long wait still.
Yeah, so until that toll bridge actually opens to traffic in 2027, the margins are just deeply, profoundly negative. I mean, the net margin currently sits at a staggering negative 573.67%, with an earnings per share of negative $1.78.
Negative 573%.
Yep.
The cash isn't just burning. I mean, it is vaporizing on the launch pad at that rate.
It really is.
And that brings us to how they're actually paying for all of this stuff.
Yeah.
Because they just recently had to raise $1 billion through a convertible note offering, right?
That's correct. Yeah.
So let's break down the mechanics of a convertible note, because it sounds like, standard corporate finance jargon, but it actually carries a very specific danger for the everyday retail investor, doesn't it?
Oh, it absolutely does. It's called dilution.
Right.
So convertible note is essentially a massive loan from institutional investors. Wall Street is handing AST SpaceMobile $1 billion today, so they can basically just keep the lights on and keep building satellites.
Okay.
But the convertible part, that's the catch. The lenders aren't just looking for, boring interest payments. This note was actually priced with a $79 conversion price.
Okay, meaning exactly. If the stock crosses that $79 threshold, what actually happens to the loan?
Well, if the stock price goes above 79, those institutional lenders have the right to convert that $1 billion of debt into brand new shares of the company. They basically just hit print on the share machine.
Wow. Okay. And every time they hit print and flood the market with all these new shares, this slice of the pie owned by, you or me, the everyday investor, it just gets a little bit smaller.
Yeah.
The company becomes less scarce.
Exactly. You're getting diluted. It perfectly demonstrates the extreme capital intensity of this business. The dilution risk is just an ongoing active reality here.
So let's talk about the valuation in light of all that cash vapor we're seeing.
Okay.
They're constantly raising money. They have negative 573% margins, and yet the market cap sits at this astronomical $26.6 billion.
It's massive.
And if you look at the price-to-sales ratio, it is sitting at 312.97.
Yeah.
Now, to put that in perspective for anyone listening, a healthy, massively profitable tech giant might trade at, what, 5, maybe 10 times their sales.
Yeah, exactly. Somewhere around there.
So at 313 times sales,
Hmm.
what is the market actually pricing in? Because to me, it feels like investors are looking all the way out to the year 2030 and pricing in absolute flawless execution with zero room for error.
Your intuition is spot on there. A multiple of 3 and 13 means the current stock price has just completely detached from what the company is today. It's entirely a reflection of the operating leverage they could achieve if and only if everything goes perfectly according to plan.
Right, perfect execution.
Because once a global satellite network is fully built and operational, the gross margins on the software and connectivity side, they become massive. You don't have to launch a new satellite every single time a new customer signs up for a roaming plan.
Oh, that makes sense.
So the market is pricing in that future high-margin utopia. But you are totally right. At this valuation, if they miss one single deadline, that multiple is going to compress violently.
Yeah, it gives us the business picture for sure. Now let's move to the catalyst timeline.
Okay, let's do it.
Because since current revenues obviously don't justify a $26 billion price tag, the only things actually holding this stock up are future events,
Yeah.
right, the catalysts. So let's look at the timeline. What actually has to happen to keep this narrative alive?
Well, the most critical thing is just moving from PowerPoint presentations to physical hardware, and they are actually doing that. On August 5th, they successfully launched 3 new Bluebird satellites into orbit.
Which is undeniably a huge milestone. I mean, having metal actually floating and functioning in low Earth orbit, that proves the engineering is real.
It proves the engineering, yes. And they have more launches scheduled for later in 2026. But the ultimate catalyst, the one that triggers the transition from a speculative science project to a real business, is the commercial timeline.
Okay, and what does that look like?
Well, Vodafone, which is one of their massive telecom partners, has confirmed a target for an early 2027 beta launch for commercial service.
Okay, but getting the technology to work in the vacuum of space, that's only half the battle.
Yeah.
Because down here on Earth, you have governments, you have bureaucracy, regulators. I know they're currently doing network integration testing across 8 different European countries, right? Like the UK, France, Germany, Spain, Romania, the Czech Republic, Ireland, and Ukraine.
Yes, exactly. They are actively testing the handoffs between the standard cellular networks on the ground and the space-based Bluebird satellites overhead.
Right. But this is exactly where my skepticism flares up big time. Because you're dealing with European telecom regulators across 8 different sovereign nations. You're asking them to allow a private space company to beam radio frequencies directly into their sovereign airspace.
It's a massive ask.
It is. What happens if those frequencies interfere with existing terrestrial networks? Bureaucracy does not move at the speed of light. If those regulatory bodies drag their feet on approvals or, demand years of interference testing, that 2027 timeline gets completely derailed.
Very true.
And as we just established with that $1 billion convertible note, time is literally money here. They're burning cash every single day they wait for a government rubber stamp.
That is the invisible hurdle right there. The technology could work absolutely flawlessly, but regulatory friction could literally starve the company of capital before they ever turn on the service. And you can see that exact tension, the excitement of the space milestones versus the absolute terror of the cash burn. It's playing out right now in the technical chart.
Oh man, the chart action on this one has been wild.
So wild.
I mean, it's trading around $68.76 right now, but the journey to get there over the last few months is just whiplash-inducing.
Catalysts tell us what could change the story, but now let's pivot to the chart because it is incredibly volatile. At $68, it is down roughly 48% from the 52-week high of $133.86 that it hit back in May.
Wow.
But simultaneously, it is still up a massive 90% from its September low of $36.08.
So if we step back and look at the trend, what is the actual structure here? Because an almost 50% drop from the highs, that sounds like a broken stock to me.
Well, if you look at the 26-week return, it sits at negative 40.6%. So that is a very clear, defined, medium-term downtrend. From a technical perspective, we're seeing a steady pattern of lower highs.
Lower highs, okay.
Yeah, every time the stock tries to rally, sellers step in at a lower price point than the previous rally. It is a textbook correction phase after that euphoric run-up we saw in the spring.
But the bleeding seems to have stopped recently, hasn't it? Because the shorter time frames look entirely different.
They do, yeah. The 13-week return has actually flattened out to a positive 5.2%. But the most telling metric here is actually the volume.
Oh, really?
Yeah, the current volume regime relative to the 3-month average is 0.67x, meaning trading volume has dried up significantly. It's well below average.
Okay, so mechanically, what does that low volume flatness actually tell us about investor psychology right now? It honestly feels like a high-stakes staring contest.
It really does.
Right, like the aggressive dumping from the May highs has totally exhausted itself. But the buyers aren't willing to step up either. Everyone is basically just sitting on their hands waiting for the next major data drop, whether that's a regulatory approval or, heaven forbid, another cash raise, just to decide which way they want to break.
That is exactly what a consolidation phase is. The market has found a temporary equilibrium. It's basically just a waiting room.
Okay, so the chart gives us price structure, but what does market sentiment look like? While retail investors are just sitting in the waiting room, what are Wall Street analysts and the company insiders doing behind the scenes?
Well, the broader news and analyst sentiment is actually quite constructive, mildly bullish even. The narrative is heavily anchored by those telecom partnerships, Vodafone, Orange, Deutsche Telekom. Bank of America recently initiated coverage, and their core argument centers on the total addressable market, or TAM. The goal isn't just to sell a new app, it's to entirely eliminate cellular dead zones globally. The barriers to entry for building a satellite constellation are astronomically high, which protects AST's potential market share.
Okay, but anyone can write an optimistic analyst report, right?
Yay.
Where is the actual skin in the game?
The skin in the game is coming directly from the C-suite. The insider buying metrics on this stock are actually the most striking data points in our entire analysis today.
Oh, wow.
Over the past 90 days, company insiders, so the executives and directors, they have acquired over 2.38 million net shares.
Over 2 million shares bought with their own money. I mean, these are the people who see the internal testing data, right? Who are sitting in the meetings with the European regulator.
Yes, exactly. And it yields what we call the management signal performance ratio of 93.37.
Let's define that ratio real quick because that sounds highly technical. What does a 93.37 actually measure in the real world?
It essentially grades management's historical track record of buying their own stock. It measures how effectively the insiders have timed their personal purchases in the past.
Okay, interesting.
And a score over 90 is exceptionally high. It tells us that historically, when these specific executives buy the dip, they're usually right, and the stock tends to outperform afterward.
Wow.
I mean, executives will sell stock for a dozen boring reasons, right? Paying for a divorce, buying a yacht, covering tax liabilities. But they only buy massive amounts of stock on the open market for one reason. They fundamentally believe the current price is a deep discount to future value.
Okay, I have to play the devil's advocate here. Because if the Bank of America analysts are bullish, and the telecom giants are signing these massive partnerships, and the insiders are buying millions of shares with an incredible track record of being right, why on earth did this stock completely collapse by 25% in a single week back in mid-July? I mean, the market clearly panicked about something.
That sentiment picture is useful, but we definitely still need to talk about the risks. Because they panicked about the math. That 25% drop perfectly coincided with the $1 billion convertible note offering.
Ah, there it is.
Yeah.
So Wall Street looked at the shiny new satellites and said, that's great, but then they looked at the bill and hit the sell button.
Pretty much.
The market was basically punishing the harsh financial reality of dilution far more heavily than it was rewarding the technological success of the rocket launches. I mean, the insiders might clearly see the finish line in 2027, but the broader market got entirely spooked by the massive cost of the toll bridge required to actually get there.
Which pivots us directly into the risks and the bear case, because that dilution fear is absolutely not unfounded. It is the primary vulnerability keeping the stock grounded right now. AST Space Mobile requires a breathtaking amount of capital to survive until those commercial revenues finally kick in. The bear case argues that the company is going to be forced to repeatedly tap the equity markets, printing more and more shares, diluting current investors so heavily that even if the technology succeeds, the stock price won't reflect it because the pie has been sliced into too many tiny pieces.
And as terrifying as that internal financial math is, it isn't even the biggest existential threat on the board here. Because we have to talk about the billionaire in the room.
We have to talk about Starlink.
Yep.
Elon Musk's SpaceX is moving aggressively into the exact same direct-to-device market. And the sheer scale of their advantage is daunting. I mean, they have significantly more satellites already deployed in orbit. They have access to immense private capital. But most importantly, they are vertically integrated.
Let's expand on that vertical integration, because that honestly feels like the ultimate trump card in space. It's not just that Starlink has more satellites ready to go. It's that SpaceX owns the rockets. It's like trying to compete in the railroad business. But your competitor owns the trains, the tracks, and the steel mill. AST SpaceMobile has to pay massive fees to companies like SpaceX just to get their hardware into orbit, whereas Starlink is essentially launching at cost.
Exactly. One analyst explicitly warned that AST SpaceMobile might be facing a too little, too late scenario as Starlink rapidly widens its infrastructure lead.
So this is the critical question for the long-term wealth thesis for you listening. If Starlink already has the infrastructure lead and the capital of SpaceX behind it, is AST SpaceMobile in danger of being the Betamax to Starlink's VHS, even if their telecom partnerships are strong? I mean, AST undeniably has the advantage when it comes to existing telecom partnerships. By acting as a white label service for Vodafone or Orange, they tap instantly into an established customer base. But Starlink has the rockets, the capital, and the speed. Does the superior partnership model win out, or does the sheer brute force speed of Starlink's deployment corner the market first? Because if Starlink secures their own major telecom partnerships before 2027, that first mover advantage that AST is banking on could evaporate overnight.
It is a classic high-stakes technology race, and there are absolutely no guarantees.
So with everything on the table, what's the final verdict? We have a $26 billion pre-revenue company doing things in space that border on science fiction.
Yeah, it's wild.
They're backed by massive global telecoms, the insiders are buying aggressively, but they are burning cash at a terrifying rate, facing the constant threat of shareholder dilution and running a foot race against the most dominant space company in human history. So what's the verdict?
Well, based on the extreme fundamentals, the current technical consolidation, and the massive balance of risks versus rewards, the overall rating here is a 4, which is strictly neutral.
Neutral, meaning it is too risky to back up the truck and buy aggressively, but the upside potential is just too massive to actively bet against it.
Yeah, the official stance is very cautious, a definite wait-and-see approach. The long-term recovery scenario is absolutely plausible here. I mean, if they navigate the regulatory tape and hit their targets, the upside leverage is historic, but the path to get there is incredibly narrow.
For the investors choosing to sit in the waiting room right now, what are the specific triggers they really need to be watching to see if AST is actually staying on that narrow path?
There are 2 key triggers. First, on the fundamental side, you must watch for any concrete confirmation of that commercial revenue timeline in early 2027.
Right. Show us the money.
Exactly. If they can prove with a live beta test that this space infrastructure can actually generate cash from terrestrial cell phone users, the entire risk narrative shifts.
And what about the chart side of things?
Technically, the stock desperately needs to reclaim and hold above that $79 convertible note conversion price. If the stock can break above 79, it signals structurally that the broader market has finally absorbed the fear of dilution, digested the debt, and is pricing in genuine confidence for the commercial path forward.
But until it crosses those 2 specific thresholds, it remains a highly speculative, high-risk, pre-revenue story. And as a reminder to everyone listening, this entire discussion is purely educational and absolutely not financial advice.
Exactly.
And if you are looking to dig deeper and organize your long-term research on complex, high-stakes stocks like this, definitely check out StockOracle through the special 14-day trial link below in the description. It is an AI-aided stock research platform that brings fundamentals, OracleIQ stock appraisal, OracleValue intrinsic value estimates, AI mode analysis, watch lists, and portfolio tools all into one place.
It's super robust.
It is. Just remember, it is a research platform, not financial advice, it's not a trading signal service, or real-time market data. AI insights and valuation estimates can be incomplete or wrong, so always verify important information yourself. And this is an affiliate link, so the channel may earn a commission at no extra cost to you.
And if this deep dive helped you better understand the mechanics of the market today, please remember to subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua.
You know, it really does all come back to that multi-billion-dollar toll bridge in the vacuum of space. It is a stunning marvel of modern engineering, but until you can actually see the headlights of that very first car paying a toll to cross, you're purely investing in a blueprint. And honestly, it makes you wonder if the ultimate endgame here isn't even about winning the consumer telecom market, but governments eventually realizing this kind of orbital infrastructure is a matter of national security and stepping in. So that's something to think about. Keep your eyes on the European regulators and that 2027 timeline. Until next time.